Why you should stop risking 2% per trade. In this video, I'll be sharing why I believe the percent risk model of trading is not the best, and as well I'll be sharing what I believe is the best way to go about taking risks in the market and what has worked for me and many others. So there are two popular models when it comes to trading the markets: the percent risk model and the fixed dollar risk model. So the percent risk model is a risk model whereby the trader risks a certain percentage of their account size for any given trade. For example, a trader may decide that they are not willing to lose more than 2% of their account size in any given trade. So if, for example, their account size is $2,000 and they are risking 2%, so 2% of $2,000 would be $40. So when they are beginning, they'll risk $40. But if, let's say, for example, they grow their account to $2,500, now in their next trade, they'll trade 2% off. They'll risk 2% off that $2,500, meaning they'll risk $50. And if the account size drops, let's say to $1,500, they'll also reduce how much they are risking, but the percentage is still the same, 2%, meaning at that moment they'll be risking $30. So that is important to understand about how the percent risk model works. It is based on the account size. So the second popular risk model is the fixed dollar risk model. In the fixed dollar risk model, a trader determines a dollar amount that they are willing to lose in any given trade, the maximum dollar amount that they are willing to lose in any given trade. And the difference comes in that even though their account size grows or even if it drops, they always stick to this dollar amount and never increase it, regardless of the size of the account at that particular moment. So this is a very key fundamental difference from the percent risk model. In the percent risk model, the risk per trade will grow or reduce depending on the account size. But in the fixed dollar method, it remains the same whether the account has grown by 10% or whether it has dropped by 10%. So now that we understand the difference between these two models, the percent risk model and the fixed dollar risk model, now which is the best? How can we evaluate and know which works best and which one we should consider adopting? To discuss this approach, I decided to do a sample of trades and a sample account size and be able to simulate, to be able to see over a series of trades which particular model will actually work best. So for this particular simulation, this is what we are going to do. We are going to assume that our account size is $10,000, and then for the percent risk model, we'll be using 2%, the popular model of risking 2% per trade, and then for the fixed dollar model, we'll use $200 as the fixed dollar amount. And the reason why we picked $200 is so that at the starting point, the percentage that is risk for each and every account is the same. So no account is risking more than the 2%, just to make it fair. So $200 of $10,000 in the fixed dollar method is 2%, and the beginning point as well for the percent model, it is 2%. So we are going to simulate 30 trades, 30 wins, a series of wins and a series of losses. So for this to be able to do this simulation, we'll have to make an assumption in terms of the win rate. What is the probability of this particular trader to be able to make wins and or unfortunately make losses? So based from my own personal experience, a 40% win rate is something that is very achievable. And in addition to that, something that I hadn't added was as well, will in this particular model for both of them, will make sure that whenever they lose, they are losing what they've determined, the 2% or the $200, and whenever they are winning, they will win 2 times how much they are risking. So like for the percent risk model, they will win 4%, 2% times 2, and for the fixed dollar method, they'll win $400, which is $200 their risk amount times 2. This is one of a popular and an encouraged method to be able to go about determining your take profits. It's something we may learn later on as I share in my journey about money management. So subscribe if you are not, so that you'll get it when you actually discuss it. So this is how the simulation went when I did the simulation. So we're all starting at a point of $10,000. So after a series of 10 trades of having 6 losses and 4 wins, this is what happened. In the percent risk model, the account size is now at $10,363, and in the fixed dollar method, it is at $10,400. So the net effect is that at this level, the fixed dollar model is ahead by $37. So up to this point, the fixed dollar method is winning by $37. So if we maintain the same win rate, same scenario, same money management whereby we're winning twice our amount, where will we end up at 20 trades? So after the next 20 trades, this is where we will be at. In the percent risk model, the capital will be at $10,739. And in the fixed dollar method, the capital will now be at $10,800, with the net difference being that the fixed dollar method is ahead by $61. So we can see that from the 10th trade to the 20th trade, the fixed dollar method has been able to gain even much more momentum, from a difference of $37 to now a difference of $61. And I didn't want to end it here. I wanted to end it up to we do another 10 trades. So after another 10 trades, after the 30th trade for each of these traders, this is what happened. In the percent risk model, the capital is now at $11,129, and in the fixed dollar method, the capital is now at $11,200, and the net effect being that the fixed dollar method is now ahead by $71, ahead of the percent risk model. So I hope this simple illustration has helped to give you an idea of how powerful the fixed dollar model is over the percent risk model. It has an edge that compounds over a long series of trades that will help you to become a better trader. But are there any other benefits? This is what I want to share next. So the other benefits of the fixed dollar risk model is that it will help you to have faster recovery from drawdowns. As any trader has experienced, drawdowns are inevitable. Times when you lose money in the markets are inevitable. And the powerful thing about the fixed dollar model is that when you stick to it, you'll be able to recover faster than when you're using a percent risk model. The other benefit of the fixed dollar risk model is that it will help to give you better control of your emotions. The reason I say this is that whenever you are trading with the fixed dollar model, you will be able to determine how much you are risking per every trade. And after a series of trades, you'll almost become used to how much you are risking per trade, because it is the same amount over and over. But with the percentage model, when you're having a good series of trades and your account size is quite high, you are now risking a higher amount than what you had been comfortable before. So this, I have found that it can make you become a bit uneasy when you are trading, and you never want emotions to get into your trading, as you may have known or experienced in your own personal trading. So it will give you better control of your emotions. So I hope you found this video helpful and will consider implementing what you've learned in your trading. And if you'd like to see other videos that will help you to become a profitable trader based on my experience, then check out the videos on your screen so that you can be able to learn more. I'll also like to invite you to check out my trading strategy at eToro on my profile page, and as well invite you to copy my trading activity and join me in the journey. So see you next time, see you in the next video.